Okay, we're going to talk about USDA loans, RD loans, same company, same thing. USDA stands for US Department of Agriculture, RD stands for Rural Development. They're one and the same. They just have this extra name that has been passed around over the years. They are a very interesting loan. We used to do quite a bit of them. They've definitely slowed down. They are a true 100% loan, so you can get in with a zero down payment. That's just what they're set up for. In fact, if you have 20% or more in your savings account or your checking account, you can't even use their program because they want to do 100% financing. So that's a little note. Not in retirement accounts. You're okay to have a high balance in your retirement account. So let's talk about the first thing that's probably the most strict, and that's going to be the location of the property. You're either in or you're out. It's like the club. You're in or you're out. There's no in between. And that is based off of the demographic of the area. So less population in our area in Idaho Falls, the boundary keeps getting pushed out just a little bit further as town grows out of where you cannot finance. If you're right in the middle of Idaho Falls, you can't qualify. We can't even, you could be the perfect candidate with scores, debt ratio, amount of money you make, all of that. But if that house is in the middle of Idaho Falls, can't do it. It's just not even possible. Get to the outskirts, Shelley, Rigby, some of those, then yeah, you're going to be fine. Property is very strict. What's interesting is you have these rural properties, it also cannot be income producing. So you have some outlying areas that have some barns and some sheds. If it is potentially going to be income producing, that could definitely throw a curveball at us if we have a USDA loan we're trying to do on that. So property specific, location specific, you're in or you're out. That's what it is. Credit score wise, they really like a 640 credit score. If we're less than that, it's potential that we can actually get the loan approval, but we have to have really good income in comparison to how much we have outgoing with our debt. So 640 credit score is ideal. That's what we were hoping that we'd have. The biggest piece of a rural development loan is going to be the income. We have to calculate two different types of income. One is going to be, this is how much money I make. This is how much money fits the guideline. This is how much money I can document that I've had for the last 2 years, and there's a little bit to the employment history, but this is the income that I can actually document that meets the guidelines. That's what I qualify off of. That's what I have to have my debt to income ratio around a certain number for. Then the other side of that is household income. I cannot make too much money because it's set up to be a low to moderate income program. The household income column counts every bit of household income that comes in, not just the ones that are on the loan, not just the job we're using to qualify. Every bit of income that comes into that household, we have to count. Meaning this, the household income, let's say a base wage of one wage earner is 60,000, a base wage of the other one is 40, we're under 100. As long as we've got a couple of kids, we're going to be okay for the household income. Now, kick that over. Is that $100,000 enough to keep our debt to income ratio in line? Okay, we might still be okay. Here's where it gets a little tricky. I don't have the chart memorized, so bear with me on this just a little bit. But for our scenario, we're going to say we make $100,000. I, as the lender, have to look at the tax returns. And I look at the tax returns, and I see husband has a little side gig that he does. He files a little Schedule C, makes another $40,000 for the year. Ha, that's awesome. Not on USDA. We have to count that $40,000 against your household income. Your debt ratio might be beautiful. You might have a perfect property location. You might have a 700 credit score. But if you have $150,000 in annual income that we have for the household income calculation, can't do the loan. Can't qualify you off all of that income unless it checks all the boxes. But the household income can truly deny your loan. Very strict rule there that goes with property. You have to fit in the box of the income and you have to fit in the box of the property. Strict. If you have self-employment and it is going to cause an issue to your household income and you can't qualify and you're no longer doing it, we can prove that. And it's not just write a letter saying I no longer do it. It really means, provide your bank statements for the last few months of your business account. Provide the termination from the state that you've canceled the business. Provide something from a CPA saying you're no longer doing that business. You have to have some pretty solid documentation to prove. You can't just, oh, yeah, just kidding. I'm not doing that business anymore. That's kind of fraud. We probably shouldn't do that. The household income's tricky, and it's based off of how many children you have. If two married people are in a home and they have one child, that's a different income. If you have 7 kids, the higher the amount of numbers of kids, the higher the income for the household you can be. The greatest thing about the USDA program is it lets us borrow what the appraised value comes in at. On the value of the home is really cool. Let's say we're buying a house for $300,000 and the appraisal comes in at $310,000. Okay. 300,000 purchase price. That's what I owe the seller. And in our perfect world, the seller's covering the closing fees. So we have a $300,000 purchase price, seller's covering all the closing fees, so we don't have to worry about that. But the appraisal came in at 310. Did you know that we can finance up to that $310,000 number and we can use that $10,000 extra to go towards cosmetic repairs? So if I want to put new carpet in, maybe I want to put new countertops in. So let's recap on the USDA loan. 640 credit score is ideal. Debt to income ratio, we have to use the qualifying debt to income ratio, the qualifying income. Then we have the household income that we have to take behind that. Then we have the property. The property has to have a certain location and it cannot be income producing. So we have very strict requirements on the property. The household income piece and the property piece, those are the ones to be the most conscientious of. It's kind of interesting this used to be so popular. I used to laugh 15 years ago, and if any USDA people listen to this, actually the one guy I used to do a lot of business with, he was so old 15 years ago. I bet he's dead now, but we used to always joke, if you can breathe, you can get a USDA loan. That's how I felt those guidelines were, which doesn't surprise me that now they've tightened them up because it was pretty lax to be able to get a USDA loan when it came to qualifying. I'll leave you with this. USDA loans are definitely an option, something that we should definitely entertain. I think we live in a world right now that our price points here are so high that we need all the income that we can get to qualify. And in order to use all that income, we probably are over income. USDA loans are awesome. It's an easy calculation for us to figure out whether or not you qualify on the household income because we can stack all your income in and see if it's going to be over on the chart. And then on the property location, like where do you want to try to buy? And if it fits into that little box, then we know we need to go down the path to see if we can get you qualified credit score wise and the actual qualifying debt to income ratio. So with that being said, USDA loans, awesome. Maybe not as popular as they used to be in our area, but they're definitely something to be aware of. 100% financing, maybe you can finance in some repairs. It's a pretty good gig. In my seat, I just try to educate any way I possibly can so that people know what they are able to do when it comes to home financing. So if you like to hear what I have to say, because I do have some really good things to say, definitely follow, subscribe, share this with your friends and family members, and make sure that you guys get as educated as you can with home loans because there's a lot of misunderstandings out there and there's a lot of things that people don't know. Definitely know a lot of stuff I want to share. So with that, Mortgage Queen out. Thanks so much for listening. I really appreciate it. So stay tuned. We are going to learn some more next time.